Hi, this is Seth David from the world famous Nerd Enterprises Incorporated, and today we're talking about whether or not your tax return agrees to your books, or maybe it's better to say whether or not your books agree to your tax return. And in this webcast, I'm showing you how to use a template that I've created in Excel, which will enable you to quickly and easily run a report in QuickBooks, drop it into the template, go through your tax return, and put the balances in the appropriate places so you can not only figure out whether or not it agrees, but if it doesn't, the adjustment that you need to post in QuickBooks is already in place by the time you're finished with the analysis. So the first thing we need to do is we need to come over here to Reports, we need to go to Accountant and Taxes, and we want to run the trial balance report. Once you've run the trial balance report in QuickBooks, you're going to export it to Excel and you're going to get something that looks just like this. And the thing you need to do is just come down to where the first account starts, highlight all the way down to the last account, and shift arrow over to grab the debit and credit columns. And that's why this is a trial balance, is because it's balancing the debits and credits. And it's doing it for every single account that you have on the books. So Control C to copy. I've got the template open that I'm essentially here to show you. The first page just lets you enter the company name and the adjustment date. That's important. You want to make sure that you're clear about what period you're adjusting for whenever you're doing journal entries. Then we come over to the trial balance here, and you're going to come in just below where it says account here on the left hand side and paste the values. It's important that you just paste values so that you don't ruin the formatting of the template. Then what it does is it calculates the adjustment here initially, assuming that everything that you're adjusting to is going to be 0 because you haven't done anything yet. This is where you're going to start doing your work, and that work means actually going through and plugging in the balances. So looking very quickly at the balance sheet from a tax return, we have a balance sheet. Unless it's a sole proprietor, you're going to have a balance sheet on your tax return. The example I'm using is an S Corp. I have the permission of the person, without the name of course, to use this balance sheet and some of the other stuff I'm going to show you, because I wanted to find a simple one, and obviously on a sample company I don't have a tax return to compare with. So the cash on this shows $3,669. I come over to my trial balance here, and I've got two bank accounts on the books, and sure enough, when I highlight both, I can look down to the bottom right. They both total to $36.69. So I can paste those values in. I know because I know they agree now. And notice the spreadsheet calculates that now there's nothing to be adjusted. That's what this template does for you. I've written a very complex formula. It's a very deep nested conditional that basically analyzes whether we're starting out with a debit or credit and whether we're ending up with a debit or credit, and based on the difference, what we need and how much. You know, whether we need a debit or credit and how much it needs to be to get from what's on the books to what we need it to be, which is what's on the tax return. Now, mind you, we're going to look at accounts receivable now. According to this, accounts receivable should have only been $485. Reality is it should be 0 because most companies are cash basis taxpayers, which means there's no accounts receivable. I'm not even sure why there's this $485. It might not have been trade related. It might have been some other receivable that we left on the books. Whatever it is, the bottom line is accounts receivable should be eliminated for tax purposes, and we want our books to reflect that. So we're going to post this entry, and we're going to zero out the receivables, and then if you're paying attention, you're going to ask a good question, which is, but I actually was owed that money, and the answer is absolutely. So what we're going to do on a lot of these is we're posting this on December 31st, 2009. January 1st, 2010, we're going to post a reversing entry to reverse out all those timing-based things that really were accurate. They just shouldn't be on the tax return, like accounts receivable. The other thing that comes up is a lot of these differences we're going to find between the books and the tax return are differences because, let's say, and I've seen this happen a lot, somebody went in and changed an invoice because the invoice hadn't been paid yet. It was on the books, and somebody said, oh, I'm not going to buy one of those items that you invoiced me for. And so we go in and we issue a discount on that invoice. Well, that invoice is posted in 2009, which affects the 2009 books. So the appropriate action to take would be to post something on January 1 or later in 2010. But since we didn't do that, this adjustment is going to take care of that, but then we're going to reverse it because the reality is there should have been less income recognized. So that's the purpose of this, and that's why it is important to get it to agree to the tax return for just a minute as of December 31st, and then reverse a lot of it. But we have to go through line by line when we're reversing even and determine which things are really permanent adjustments and which things actually need to be reversed. The accounts receivable is always going to be one of those that will need to be reversed. I'm going to run through the rest of this very quickly, because this is essentially what you're going to do. Is you're going to come here, you're going to look at the balance sheet. I did the accounts receivable, we've got other assets of $56. That looks like this balance right here. So again, I can come in and always pasting the values on this. And we probably should get this person's name out of here, so I'll make sure that I blur it out before I put this recording out there. But we've got that's the $56. Coming down, I've got fixed assets of 74 and change, 74,848. So I can come over here once I've confirmed that the total agrees, paste the values in. Notice again it's calculating no adjustment needed. I've got accumulated depreciation of 35,219. Chances are the depreciation adjustment was never booked. 35,219. We've got that, so but I put it in the wrong column. Remember that it's important to know your debits and credits on these. So I need to have 35,219 in the credit column. So we're going to have credit to accumulated depreciation of 79,17, and further down, I'm not going to go over it in this webcast, but when you do it, you're going to see it's going to come up that you're going to have a debit to depreciation expense of 7,917, which offsets that because it was never booked. Coming back down here, I've got my intangibles is 178 with 105 of accumulated. So there's my 178. I can paste the value in real quick. And my accumulated was 69. Again, this is in the credit column. I put in 105. And obviously, as you can see, it's going to help to know your debits and credits on this. So I have a free webcast on that. I just recently put it up. So check the Toolbox for Finance blog. Look for the accounting video blog on Toolbox for Finance, and you'll find my post on, or my video tutorial and blog post on what's normal, debits and credits. So that's how you're going to put this together based on the balance sheet. When you get to the P&L, the tax return doesn't have every single line item the way your books might. So what you're going to need to do is you're going to need to look at the schedules, because your CPA attaches schedules, and here's an example of one where here's the other deductions. So these are the line items from the set of books and each amount and what it totals to, the $21,292. So we look for the accounting here, and I find accounting in the expenses here. And it's probably under professional fees. So this part may take a minute. And there it is. Now this one only says $1,500, but don't sweat yet, because there might be another line item that for this purpose the CPA combined with accounting. There might be. If not, then we need to put the $1,650 in there. And the difference is $150. So the clue is you might look for a line item for $150 and see if that was combined. So this part's going to take a little more work, but I wanted to make sure that I at least covered enough of it in the webcast that it should give you a good enough idea that you can kind of continue on your own and figure out how this works. But when you're done, what you can start to see forming is your adjustments. So we're going to have a credit to accounts receivable, and then we're going to go into QuickBooks and we're going to make an adjusting journal entry, and we're going to book this entry. And then if you have a look in QuickBooks, you'll see there's a button to reverse it. I'll show that to you. So looking at QuickBooks, what I would do is I would come here and go to Company, and I would say Make General Journal Entries. Now here's one of the real kind of good things about this. If I flip back over real quick using my Alt Tab, and I want to post the accounts receivable adjustment, all I have to do is Control C, Alt Tab, Control V. And then I can come over here, I have my credit. I can come in here and Control V, paste my credit. Come down, next thing that needs to be adjusted is this retainer clients. We're taking that out. Now this one is, because I'm not using the same company file, it's not consistent. I'm using a sample file to show you just how to post the entry. So in this case it wants me to set up the account. I'm not going to do it. But I wanted you to get the idea that you can do a quick copy and paste on a lot of this and have the adjustment posted in a very short time. Mind you, when you adjust accounts receivable, there needs to be a name associated, and since there's no one specific customer that this is being adjusted for, it's just being adjusted for all of them, I will often create a customer called Accounting AJE, because again, this is going to get reversed. And the way we're going to reverse it, and I'll quick add this into the customer list. The way we're going to reverse it, once we've posted this, we hit save and close, we come back to the adjustment, here's the button that says reverse. And what this will do is it will take the entire adjustment and literally flip the debits for the credits, and also it will advance the date. Usually it recognizes if the original adjustment was on December 31st, it will advance the date to January 1st. Normally what we'll do though is we'll generally just advance it by 1 day. So if your adjustment date is on December 15th, as you see it is here, then it's probably going to, when you hit reverse, move it to December 16th. So mind your dates. But the thing I wanted to stress here is that once you hit reverse, you're not ready to save and close. Then you have to go through and eliminate the line items that are not temporary. For example, your depreciation adjustment is a permanent adjustment, so that should not be included in the reversal. And that's basically it. I know it's a lot. I'm giving you as much as I can in a short webcast. Call me at 866-945-8070 if you have additional questions or you would like additional training. And my email is seth@nerdenterprises.com. As always, I hope you found this helpful, and I do sincerely hope that you are having an absolutely fantastic day. One last time, this is Seth David with the world famous Nerd Enterprises Incorporated. Today's lesson was on adjusting your trial balance, how to make sure your books agree to your tax return. Call for additional training or consulting at 866-945-8070. Call and ask about this or any other topic I cover, and don't forget to download the trial balance template in my Knowledge Center. It's available right now. Just click through on the link which will be posted anywhere you see this video.